Hi, welcome to Foundation Module number 6. We're going to look at technical analysis now, which is a cornerstone of the trading world and a vital skill for you to understand and practice on your journey to become a trader or have a better understanding of the markets. And hopefully then you'll have that all-rounded, sustainable, disciplined approach to the markets whenever you're ready to approach them. For me, technical analysis, I always called it a pseudoscience, and someone had called it financial astrology to me quite recently, which made me chuckle because it kind of is. But it exists because everybody looks at it and everybody uses it in the trading world. And it's very important for you to understand. So here we go. Foundations, number 6, technical analysis. I hope you enjoy it. And as always, see you on the other side. Good luck. Technical analysis, module number 6 on this series of foundation videos for those who are new to trading or aspiring traders that need a little bit of a leg up and understanding from a professional on how these things work. Going to hear a lot about candles, lines, which sounds pretty random. And as someone put it to me recently, they call technical analysis financial astrology. You can come to your own conclusions after you've watched this video. TA, as we call it, technical analysis, is the study of price. And it's the study of price in chart form. We'll come on to those and you'll see a couple examples in a minute. So I very often call this a pseudoscience of markets. It's the study of price and market data to then interpret behavior and direction of markets into the future. It's very much a snapshot of the past, of price discovery, of where prices have been. And we have all that information shown in candlestick form. And we use that to form ideas of where the market might be going in the future. So it tells us where the market's been and then gives us those clues for where it is going next. And why I use it? Everyone else is. This is why I call it a pseudoscience. It works because everyone in the market is using it. Everyone's looking at these charts. It is an industry standard. And specifically the candlestick charts with the red and the green, as we'll go and see in a minute. If everyone's using it and everyone's looking at the same patterns, it's only natural that people come to the same assumptions. The price is objective. It reflects collective behavior. A mass of buyers or sellers all convening at the same time. And it shows that supply and demand, those buyers and sellers, in action. And we can see that graphically on a chart. And that TA, we use it as a good structure for execution. Even if I've got a macro idea that's all in all fundamental analysis as per the last video, I will always look at the chart and understand how can I finesse that, or can I finesse that using technical analysis skill. TA works because human behavior essentially in the markets is repetitive. There's a saying, history doesn't necessarily repeat, but it certainly rhymes. And that's the same in markets and it's the same in human behavior. And that's what we're looking for. We're looking for markets to generally rhyme and take similar shapes and direction as they have done in the past. So let's introduce that candlestick that you've heard me mention a couple of times. This is the de facto chart that 99% of traders use around the world in all markets. We use it because in such a small candle it has 5 vital points of information. Okay, we've got the direction, which comes from it being green or red. If we see a green candle, the direction is up, and each candle represents a period of time, and we can change that period of time. That's one of the variables that we have. There's tons of variables, and there's loads of indicators we can use in technical analysis using candlestick charts, but I'm going to stick with the basic principles. Candlesticks are, if you see green, it means it's gone up in that session. And then we have what's called the body, which is that bit in the middle, the thicker part of the candlestick. So on a green candle, the bottom of that body is where that price opened in that time scale, whatever our time is for our candlestick chart. It could be 1 minute, 10 minutes, 30 minutes, 60 minutes, a day, a week, all of these time scales to give us all that information over a period of time. And those candlesticks will give us the information in that time period. So let's say 10 minutes. This is a 10-minute candle. In 10 minutes, the bottom of the body is where the market opened. In that 10-minute period, we went to the high of the wick, which is the thinner line where it says high, and the low of the wick, which says the low on the green candle. So we've got a high of that 10-minute period, a low of that 10-minute period, the opening where the market was when it opened in that 10-minute period, and then after that 10 minutes is up, that candle's done its job, told us everything in that 10 minutes, and then the top of the body is the close of that 10-minute period, the price that ends that 10-minute period. Okay? So in that 10 minutes, that candle shows us all this information. It doesn't show us how much volume is traded at every price and where everything's traded every minute. Just in that 10 minutes snapshot of any market, that's what that green candlestick's telling us. It's gone up in that session. High, low, open and close of that 10-minute session. And then we move over to the bearish candlestick. So that was a bullish candlestick. It was going up, bearish. So it signifies the market's going down. We'll use the 10-minute analogy again, 10-minute period. It opened at the high of the body this time. We've traded as high as the high of the wick, as low as the wick. And then at the end of that 10 minutes, the market is closed at the bottom of that body. So we know where the market's closed in that 10-minute period. Again, we use 10-minute example there. I trade multiple time frames, we call them. 60-minute charts, daily charts, weekly charts. I experiment with them all. I have a short, medium, and long-term principle. I talk about this a lot further on in the course. And we look for trends, essentially. This is a very good visual aid. There's a lot of simply greens and reds. If it's bullish or bearish, we can see visually. On the left here, we've got a bullish chart. This is trending upwards. A lot more greens and reds. You can physically see the direction of the candlesticks is moving up. And then you've got the opposite, which is a bearish move in a bearish chart. Lots more reds. Very visual. We can see the chart is moving lower to the right. You always have time on the bottom and price on the right. This is very important. So time on the bottom, price on the right or left. But time is generally on the bottom axis. Okay, x-axis. And I'll have a little introduction to support and resistance. This is the real basic stuff and the foundation stuff that you need for technical analysis. We're talking about bullish, bearish candlesticks. You need to understand about support and resistance. Support is given. These are called support trend lines, for example. I go into more depth of how to draw these and how I use these as a professional later on in the course. But essentially, this is a support line. You can see the market's trending upwards. It's a bullish trend line. And you draw these between, it's kind of trader's choice, really, between points on a graph, on a chart, and then you extend it, and then this becomes almost a guideline for future trades and future direction. So that's a support line on the bottom side, and then you have the opposite, which is a resistance line, a resistance channel. This could be, and it's a bearish resistance line or a bearish resistance channel. Again, as well as diagonal lines, you can have support and resistance lines horizontally. This is actually what's called double top, one of my favored technical analysis indicators, where you have two points that are the same price, and you join them together and you extend that line, and that becomes a double top resistance line, for example. But again, this provides a technical. They don't work all the time, but they're indicators that you use to give you a potential advantage of finding an opportunity in the market. You know that when all the market's looking at this point, because the price has been hit there twice before, so you've got to be alert to when it hits there again. And this is why we draw these lines. So it's a lot. Technical analysis is a lot about finding areas that are interesting in the market, that have traded before and caused a reaction and kind of cause and effect. So when they get there again, we can then decide whether or not it's an opportunity and we want to trade there. And often with support and resistance. So you've got the resistance line there and the support line on the right. So that's double top on the left, double bottom. So we've got resistance on the left, support on the right. What technical analysis is not. It's definitely not certainty. It's not a prediction. And it's 100% not guaranteed. From a professional approach, always got to identify context, overall direction of the market, key price points that have been triggered in the market before, prior to where the market is now. Always bring it into the fundamentals and understand what the underlying is doing. Use it to help refine entry and exit. Use it to help manage risk and help you stay aligned with the overall market structure. Okay, if news is bullish, if opinion's bullish and the charts are bullish, chances are the market's going to be going up and it's bullish. It's a very, very important part of everyone's trading toolkit. Some common retail and junior trader mistakes that I've seen over the years, and there's a very high chance that you'll do this. Overcomplicate charts. I remember many junior traders having so many indicators on their charts that it looked like a bowl of spaghetti, right? And there's a word for this, or a phrase for this. It's called paralysis by analysis. And I've seen this too many times with junior traders, and retail traders the same, that there's so many indicators you don't know which one to operate with. That's why I have another acronym that I've always used, is keep it simple, stupid, when it comes to technical analysis. And I have maybe half a dozen or so, maybe 10 max, of indicators that I'll regularly use day in, day out. I'll experiment with some others on my journey, but those 10 are staples, and I'm the expert in them. So I'll know how to use them on all of the markets that I trade as a multi-asset trader, and I'll use them consistency, because that brings consistency. And I'll learn to use these indicators as I teach further down the line in various other classes and modules. Using these are very important to get used to them, to building a skill and understanding for them, to then implement them on the market to help you identify and execute trades successfully. So too many indicators added. Trying to trade every pattern gives you that paralysis. Ignoring higher time frames, focusing on a 1 minute chart or a 5 minute chart only, and being too involved in the noise and not being able to almost take a step back, looking at the daily and weekly patterns and then not having them intersect. That's also a big issue. And then getting over obsessed with technical analysis. I've met a lot of traders and traders that I've trained that just won't step away from being hyper-focused on charts. And it's like, you have to understand that there's more than just the charts moving the markets. It's very important. Okay, the key takeaway: the chart is telling you what happened. Your job is to find out what happens next. That's all we care about as traders. So that was technical analysis. A little bird's eye view and that foundation to understanding the basics of technical analysis, and hopefully opening that door for your curiosity to take over and find out more about technical analysis and have a greater understanding when you're looking at those charts. There's much more to learn about technical analysis and how us professionals use it. A lot of what I do as a coach and an educator and a trader involves technical analysis, and those skills that I have built up over the years, which I try and teach for other budding traders to understand, to then go on and succeed and have a greater chance of success in the markets. So hope you enjoyed that and are enjoying the series. We're over halfway now, module number 6, and we're going to move on to module number 7 now. So good luck as always, stay lucky, and see you in the next module.